Hey everyone, welcome back to Corporate Decoder, the place where we try to unpack the secrets companies try to hide in plain sight. And let me tell you, this filing has some interesting details about two new exchange-traded funds. Did you know that investing can feel like a gamble, especially with new financial products? This filing is all about two new funds, the founder, ELD ETF and the founder, led 2x Dalton's ILI ETF, and they come with a whole bunch of risks and strategies you need to know about before putting your money in. And hey, if you appreciate getting straight insights from corporate documents like this, make sure you are subscribed. We also have a Discord community linked in the description below where you can connect with other savvy investors. So we're looking at a pre-effective amendment to a registration statement on Form N-1A. Think of this as a company filing with the SEC saying, hey, we want to offer these new investment products to the public, and here are all the details you need to know. It is all about transparency, but sometimes that transparency is buried in a lot of legal and financial jargon. There are two main players here, the founder, led ETF, and the founder, led 2x Dalton's ILI ETF. The first one sounds pretty straightforward, right? It aims to track the performance of an index called the founder. Led Index, this index is all about companies where the original founders are still in charge in key executive roles. It is like a nod to the entrepreneurial spirit, but with a financial twist. The second fund, the founder, led 2x Dalton's ILI ETF, is where things get a bit more exciting and frankly a lot more risky. This fund aims for daily investment results that are double the performance of that same founder-led index. But here is the kicker, it only aims for this daily double performance. Over longer periods, thanks to something called compounding and daily rebalancing, your returns could be very different from just double the index's overall performance. This is a big deal. Imagine a roller coaster that resets its speed every day. Your ride might be thrilling, but it is unpredictable over time. Now, when it comes to fees, the founder, led ETF has total annual operating expenses of 0.49%, a little over 0.5%. That is not too bad for an ETF. But for the founder, led 2x Dalton's ILI ETF, the management fee jumps to 1.08%. That is more than double. This higher fee is especially important when you consider the added complexity and risk of a leveraged fund. These fees eat into your return, so it is crucial to understand what you are paying for. Let's look at the expense example. For the regular founder, led ETF, an investment of $10,000 might cost you $50 in the first year. If you hold it for 3 years, it goes up to $157. That is pretty manageable. Now for the 2x Dalton's ILI ETF, that same $10,000 investment could cost you $110 in the first year and a whopping $343 over 3 years. That is a significant difference, and it is just based on those operating expenses, not including trading costs or potential losses. The strategy for the founder-led ETF is passive, it just tries to follow the index. But the 2x Dalton's ILI ETF uses derivatives like swaps and futures. These are complex financial tools that can amplify gains, but they also amplify losses. It is like using a magnifying glass on your investment, magnifying both the good and the bad. Now let's dive into the risks because this is where the real story is. Both funds list a ton of risks, but some are more important than others. For the founder-led ETF, you've got risks like AP and market maker dependence risk. This means the fund relies on a few key players to keep the shares trading smoothly. If they pull out, your shares might trade way above or below their actual value. Then there is the premium discount to NAV risk. This basically means the price you see on the stock market might not be the actual value of what is inside the fund. This can happen especially when markets are wild. And don't forget index calculation and methodology risk. This is the risk that the index itself could be calculated incorrectly or have problems. If the index wobbles, the fund wobbles too. A specific risk for these funds is concentration in founder-led companies risk because the index is focused on founder-led businesses. That means the fund might be heavily invested in a few specific types of companies, which could make it more sensitive to problems in those areas. Both funds are also classified as non-diversified. This means they can put a big chunk of their money into just a few companies. If one of those companies tanks, your investment could take a big hit. But the founder-led 2x Dalton's ILI ETF has a whole new level of risks. The big one is leverage risk. This fund uses leverage to double the daily performance. That means if the market drops by say 20%, your investment could drop by 40%. In extreme cases, a 50% drop in the market could wipe out your entire investment. This is not for the faint of heart. Then there is holding period and compounding risk. Remember what I said about the daily double. Over time, compounding can really mess with your returns. If the market bounces around a lot, you could actually lose money, even if the index as a whole goes up over a longer period. It is a mathematical quirk that can be very costly for investors holding for more than a day. Correlation risk is another big one for the 2x FUND. It means the fund might not perfectly track double the index's daily performance because of fees trading costs and the way derivatives work. And let's not forget swap agreements and other derivatives risk. These are the tools used to get that leveraged exposure, and they come with their own set of dangers, including the risk that the other party in the deal might not hold up their end. Now, about portfolio turnover for the regular founder. LED ETF, it is not really available yet because it is new. For the 2x Dalton's ILI ETF, the turnover might be really high because it is constantly rebalancing its positions to maintain that daily double target. High turnover means more trading costs and potentially more taxable events for investors. Let's look at the financials for the founder, LED ETF as of the 19th of November 2025. It is very basic right now. They have $100,000 in cash and no liabilities. This is typical for a fund just starting out. They've got cash from initial investors and not much else yet. The net asset value per S-Hair is $25 and they have 4,000 shares outstanding. This is the very beginning of the story for this fund. The management of these funds is interesting. Corgi Strategies LLC is the investment advisor and Tuttle Capital Management LLC is the sub-advisor. Matthew Tuttle is the portfolio manager. The advisor itself is quite new, founded in July 2025. And as of November 2025 had no prior assets under management. This adds another layer of risk, a new fund managed by a new advisor. The board of trustees has 5 members, 3 of whom are independent. This is generally good practice for oversight. However, 2 of the trustees, Nicholas Lacroix and Emily Zed. Yuan also have executive roles within Corgi Insurance Services and Basket Entertainment companies, which might create some interesting conflicts of interest given Corgi Strategies. LLC is the investment advisor. The filing mentions that Corgi Strategies LLC is registered with the SEC, and you can find more information on their Form ADV. This is where you typically find details about their other business activities and connections. Parallel Distributors LLC is the principal underwriter. They're responsible for distributing the shares. All the important financial records are held by Us Bancorp Fund Services LLC, which is acting as the administrator, fund accountant, and transfer agent. US Bank National Association is the custodian. So here is the deal with these 2 funds. The founder-led ETF seems like a standard passive ETF focused on a niche market. The fees are reasonable and the risks are generally what you'd expect from an ETF tracking an index. The founder-led 2x Dalton's ILI ETF, however, is a whole different beast. It is designed for short-term trading and comes with significant risks due to leverage and daily compounding. While it offers the potential for amplified daily gains, it also carries a much higher risk of substantial losses, especially over longer holding periods. The higher fees also mean you need to be even more confident in its performance to justify the cost. It is crucial for investors to fully understand how this fund operates and to actively monitor their positions if they choose to invest. In conclusion, these filings signal the launch of 2 ETFs with very different risk profiles. The regular founder-led ETF might appeal to investors looking for a specific thematic exposure. The 2x Dalton's ILI version is more for sophisticated traders who understand and can manage the complex risks involved. Alright, that is our deep dive into these new ETFs. What is your take on these strategies and their risks, do you think, founder? Led companies make for a good investment play, or is the 2x Dalton's ILI fund just too risky to touch? Let me know your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more corporate breakdowns. And don't forget to join our Discord community linked in the description. You can get more insights and discuss these topics with fellow investors. Thanks for watching Corporate Decoder, and we'll see you next time.